Hey, this is Dr. Akin, your accounting tutor that wants to see you win in financial and managerial accounting. This class specifically, or this topic specifically that I'm covering in this video, is going to be solely related to financial accounting. That is your principles one, and maybe accounting 101 for you all, accounting 201, whatever, but it's solely going to be focusing on financial accounting. And we're going to be dealing specifically with adjusting journal entries. Adjusting journal entries. Now, adjusting journal entries can be tricky. I will say that up front, but it does not necessarily have to be tricky. I believe the things that I'm going to show you in a second will give you a better understanding on what adjusting journal entries are all about. Okay. And because so how I tailor my videos are specifically how to videos. So the goal of these videos are not to lecture. These are supplemental to the lectures that you're already receiving from your professors. This is just to kind of shore up any concepts that you may have. So you definitely want to interact in the comment section with any questions, and I'll try to get to it within 72 hours. But listen, guys, sometimes in order for me to do these how-to videos, it requires me to do a mini lecture or just some background information that can be helpful to set up the larger conversation or the larger how-to practical step that we're trying to achieve here. So when we're discussing adjusting trial balance, there are a couple of things that you need to make note of. Okay. So I'm just going to put it here. So let's go with adjusting journal entries. Okay, adjusting journal entries. Here's what you need to know. Okay, the first thing you need to know, number one, is the whole purpose of adjusting journal entries is to update a previous balance. That's really it. That's all you have to think. Don't get caught up in the weeds here. Let me zoom into the notes and then I'll pull back out. Okay, so all you need to know for adjusting journal entries again is that it is updating. Let me just make it a little bit more. Updating a previous balance. That's all you're doing. Don't think nothing more or nothing less. Whenever you're dealing with updating a previous balance, you then need to be thinking about, okay, what is the old balance, right? Simple. And then B, what is the new balance? Okay. And then C, how to get from A to B. That's literally it. I know this may seem a little bit reductive, but it is the reality. It may seem a little bit too simplistic, but it is the reality. All you're literally thinking whenever you're thinking about adjusting journal entries is, okay, I need to update a balance. So when you go to look at problems, be asking yourself, what is the old balance? What is the new balance? And what do I need to subtract to make that adjustment? And that's all you're doing. Okay. So we're going to run through some adjusting journal entries together. Now, before we get into adjusting journal entries, I do want to cover a couple of things. So this is how it happens, right? Where does adjusting journal entry stack up in the accounting equation, right? Because this is a part of a larger story. Remember, or if you're new to this channel, I encourage you to check out previous videos where I discuss about the accounting equation or the accounting cycle, rather. And if you look at my previous videos, I will try to put a reference card around here. I don't know how far or how long we've been into the video, but just be looking out if on the top right of your screen, you should see like a reference video. But I encourage you to go back to my initial videos where I talk about and discuss the accounting equation. In fact, I think it's the second video that I've ever posted on this channel, right? Because when I talk about the accounting equation, I'm also talking about the accounting cycle. Now, the goal of financial accounting is really one thing, and that is to produce the four financial statements, right? So the four financial statements is the end goal. That's the end product. So then the question then becomes, well, how do I get to that end product if that's the goal? So that is called the accounting cycle. The accounting cycle is literally a to Z a step-by-step process that you take in order to get to the goal, which are the four financial statements. So again, I'm not going to spend too much time on it because this is about adjusting journal entries, but I encourage you to go reference back to my second video ever recorded where I kind of discussed that in full detail. But in the accounting cycle, it starts off with a source document, then it moves into, so I'll just put it here just because I'm a nice and kind professor. Okay. So I'll put it here. It starts off with, so let's call this the accounting cycle, right? So it starts off with a source document. Okay, so everything in accounting starts off with a source document. Source document is a receipt, check, whatever. I'm not going to get into all that. I kind of broke that down in previous videos. Then after a source document, you get into journal entries. Okay, so journal entries, again, I've done videos on it, on how to do it. So please check out my previous videos on journal entry made simple. And I think I even did an additional video on doing some practice around journal entries. But after journal entries, you're then going to do what is called a unadjusted trial balance. So an unadjusted trial balance is a list of all the accounts that you've used in an accounting period and the amounts associated to it. Now, this is an example. This is not how it looks, but this is a simplistic example of an unadjusted trial balance. You have your list of all the accounts that you've used in the accounting uh, period, and then you have your amounts, right? And you can see it's listed by debits and credits, and it's listed based on the normal balance. Again, if you don't know what normal balance is, highly recommend you watch the video entitled accounts is accounts and T accounts and all of that made easy. All right, so I'm just putting it here for aesthetic purposes. All right, cool. So this is an example of an unadjusted trial balance. So what makes up this unadjusted trial balance is going to be the source document and journal entry, right? Once you're done with the unadjusted trial balance, you're then going to do what we're about to do in a moment, which is called adjusting, adjusting journal entries. Okay. Okay, adjusting journal entries. Adjusting journal entries are what we're going to go over in a minute. So that's where it stacks up in the accounting cycle, right? So after we do adjusting journal entries, we're then going to do what is called an adjusted trial balance, right? An adjusted trial balance. We'll talk about that at the end of this video. This is what an adjusted trial balance is. It's literally the same as the unadjusted, but now it just has the updated numbers, right? So after you do your adjusted trial balance, then you are able to do your financial statements. Okay. Then you're able to do your financial statements. So this is the abbreviated accounting cycle. So this is where we're talking about in this video. We're talking about adjusting journal entries, right? Adjusting journal entries. So here's the thing, right? Now that we know where it stacks up, I did want to show you, okay, again, this is an unadjusted trial balance, right? Which is right here. Then we need to do adjusting journal entries. So what I did was I kind of went over some journal entries, right? That happens. Okay, so I did some journal entries that is going to update this adjusted journal entry, right? So there are some journal entries that are done, okay, that I've done that occurred in December that was not captured in the unadjusted. So I put a December journal entry, right? December journal entries. Now, these journal entries that I did here, they're going to feed into our trial balance, our updated unadjusted trial balance, right? Unadjusted trial balance. So the reason why I have this here is to show you again how the accounting cycle works. Once you do your journal entries, which are here, once you do your journal entries, they then produce an unadjusted trial balance, which is here. So, say for example, you see that there was an advertising expense on December 2nd, it looked like we paid an ad bill. So, we debit our advertising expense and we credit cash. So, as you can see, advertising expense, right? We have the debit here, and cash is going to be credited here in this total amount. So, another example is that we paid for repair for our computers. So if you look here, we're going to come down to repair expense right here. And as you can see, $500 we debit. So And again, cat. So you start to see wages 660, wages here. So once we finish our journal entry, guys, it then wraps into what we call an unadjusted trial balance. Got it? All right, cool. So now that we have our unadjusted trial balance, we then need to do an adjusting journal entry. Well, pause. Why do we need to do an adjusting journal entry? Because there are some previous balances that need to be updated, right? So these are the current balance, right? But then there are some transactions that are going to occur where we then need to make an adjustment to these balance. So we have a up to date trial balance. You see? So I'm going to put that in here. That's something else you need to know, right? So I think I kind of put it, never mind. I kind of already put it in here. Updating previous balance, right? So you're taking a old balance, which is that 1A, and you are trying to figure out the new balance, which is what you see here. And the difference between here, excuse me, the difference between here and here is going to be your adjustments. So that's what I want to spend time talking about. How do we make adjusting journal entries? So here are some problems. Let me do this. I'm going to wipe all of this out and then we're going to do it together. Okay. So here's some problems that we have where we're now making additional journal entries. Okay. Even look at what it says. The following additional facts are collected for use in making adjusting entries prior to the financial statement. See, so these information, okay, these data points that are given to us are going to be necessary for us to focus on before we make financial statements. Okay. So adjusting journal entries are necessary before we get to our ultimate step, which are financial statements. One of the things you also want to know about adjusting journal entries is the transactions usually occur after the accounting period. Okay. So that's very important. Once the accounting period is over, there are going to be some transactions that occur after the accounting period. So as you can see here, if the accounting period is to December, you see that there are a lot of December 31st transactions. Why? Because there are some transactions that are going to happen after the fact. They're going to happen after the cutoff, right? They're going to happen after the cutoff. You're like, but Dr. Akin, what is a cutoff? What is an accounting period? Again, you want to go back to previous videos where I talk about the accounting period, right? But I don't want to spend too much time talking about that now. What I want to highlight again is that there are going to be some transactions that happen or occur after the accounting period. So we still have to add them into our unadjusted trial balance to help us ultimately produce our adjusted trial balance. So here's where we do some journal entries. So let's do a couple of journal entries and then we'll be done. So on December 31st, it says our inventory count of computer supplies show, very important, 620 still available. Okay. So let's just work that out. So let's work that out, right? So here we have a situation where at the end of December 31st, our balance is 620. Now, the first look, remember, you want to ask yourself three questions when doing an adjusting journal entry. The first question you want to ask yourself is what is the old balance? Okay. So if we're looking at computer supplies, we want to go to the adjusted trial balance. See, because where do we find the old balance? The old balance is going to be the previous step in the accounting cycle. So the previous step from adjusting journal entry in the accounting cycle is unadjusted trial balance. So our unadjusted trial balance, it houses, it displays, it shows our old balance. So our old computer supplies balance is what? 3,945. Okay, so I'm going to put that there. So our old balance, I'm just going to use this. Old balance is 3,945, right? Tracking? All right, cool. Then the next question is, What is the new balance? Well, it tells us the new balance here should be 620. Make sense? You see? All right, cool. So now that we have the old balance, okay, here we are. Now that we have the old balance and the new balance, the question then becomes how to get from A to B. So essentially, we want to take the difference from A to B, right? So this amount, I'm going to highlight this. This amount is what is going to go in our adjusting journal entry. So what we're going to do now is now put it in our adjusting journal entry. We know that we're going to debit 3325 and we're going to debit credit 3325, right? Because that's the adjustment between the old and the new. Now the question is, what about the accounts? Well, look at what is happening here. It says we started off with computer supplies, right? So we know computer supplies is going to be an account, but the second is what would be the second account here? Well, think about what's happening. If we started off with computer supplies and we no longer have computer supplies, what account would make sense there? If we started with computer supplies, but then we use computer supplies, what would that be? Well, you want to write it down. It's going to be computer supplies expense. Okay. Computer supplies expense. Now you're like, Dr. Akin, did you just pull that out of the side of your neck? How in the world did you just come up with computer supplies? Well, we came up with the word computer supply, or we use computer supplies account because if you go back to the previous videos, we talk about that an expense is paying or using something to continuously operating the business. Again, an expense is utilizing or paying for something that will continue operations within the business. So as you see here, we started off with a balance of 3945, but we use 3,324. So that's going to be an expense, right? So we're going to debit that as an expense. But then we want to credit, this is very important, that asset account, which is going to be computer supplies. We're going to credit computer supplies because we want to reduce that. So as you have already seen, our adjusting journal entry is we started off with 3945. We're reducing it by 3,324 to give us an updated amount, right? To match what's going on here to give us an updated amount of 620. Cool? So hopefully that makes sense. Let's do another one together. So the next one says, let me see, 1, 2, 3, 4, 5, 6, 3, 5. Okay, so I'm gonna put this at the bottom. Let me do this one last. I'll put this one last. All right, cool. So the next one says, as of December 31st, Addie has not been paid for 4 days worth of work. Okay, so has not been paid. So think about it. Now, here's another expense that is occurring after the accounting period. So after we have already came up with these numbers, we have another expense where we have not paid one of our workers, our employees. So we know that when we want to pay our employees, that's going to be wages expense. So we're going to debit wages expense. That's what we know already. What you also should know is that we're going to credit wages payable, meaning that we're going to pay them later down the road. We're not going to pay them right now. We're just acknowledging the fact that we need to pay them, okay, or a scheduled payment. So then the question is, what about the amount? In this case, you don't have to follow this template because it already tells us. It says that this person was not paid for 4 days and they get paid $110 a day. So that means $440 is what we need to put into the wages expense as a debit, and then we need to credit wages payable. Now, again, you see wages payable, it starts off with zero. That's the old balance. Now the new balance is going to be 440. So that adjustment was the credit to 440. All right. And then if you look at wages expense, we started off with 3,260 and we ended with 370. The difference is a debit for 440. Okay, so hopefully that makes sense. Now, this one is a little interesting. It says the computer system acquired on October 1st is expected to have 4-year life with no salvage value. Okay, so again, we want to come here, or let's do this. We want to come here and ask ourselves, well, what is the old balance for computer system? Well, if we go to computer system, or excuse me, computer system, yeah. So that should be computer equipment. But the old balance is 22,000. Let me update that so there's no confusion. What did we say? Computer equipment. Okay. All right, cool. So we know that the old balance is 22, right? But this is saying we don't really know what the new balance should be, but here's the information to know how to do this. Now, this is called straight line depreciation. So this is a depreciation situation. Now, I'm not going to get into it into detail because I'm going to cover that in future videos. But for the sake of your learning, this depreciation method is called straight line. In straight line, you're going to need cost minus salvage value divided by useful life. So we're going to use the information in this scenario to come up with an answer. Okay. So look at what's happening here. Remember, the formula for straight line is cost. Let me put it so straight line, it's called straight line depreciation. And I'm not going to spend too much time on it because, again, like I said, we'll go over this in greater detail in future videos. But the formula is cost minus salvage value, right? All of that divided by useful life. Okay. This is the formula. Cost minus salvage value divided by useful life. So obviously we need that information. We need to know the cost, salvage value, and useful life. So in this problem, we know that the cost is 22. We also know that for computer equipment, let me put that, it's going to be, computer equipment is going to be 4 years. Okay, so give me 1 second. I just need to update some of this stuff. This is going to be 5. And then this is going to be 5. Okay, cool. So we're going to update. Okay, so we know that computer equipment is for 4 years, right? So we have 22, zero salvage value because they say no salvage value here, and then useful life is 4. Okay, so cost minus salvage value. So 22 minus 0 is 22,000. Then we need to divide it by the useful life. Now, the useful life is 4 years, but we don't need this in years. We need it in months. So we're actually going to do 22,000 divided by 48. Okay, so that means that the new balance should be, well, we know that, excuse me, we know that it's going to be cost, right? So let's do our formula. It's going to be cost minus salvage value divided by useful life, which we're going to do it in months and not years. So you see that we're doing it in months and not years. So that's going to give us $458.33. But we're not done here. The reason why we're not done is because this $460 is per month. But it says though we acquired it from October, but we're in December 31st. So we actually have to do depreciation every single month up until December 31st, starting from October 1. So October, right, to October, November, December, 3 months. So we're going to multiply that by 3. So that means that our total depreciation is going to be $1,375. Now let's talk about really quickly what accounts are we going to use. Well, we're going to debit depreciation expense computer equipment. That's what we're going to debit. And we're going to credit accumulated depreciation computer equipment. Okay. So these are the accounts. Now you're like, but Dr. Akin, why are we using these accounts? We're using these accounts because Depreciation expense, and I'll talk about this in future videos, is again, this is the amount of money we're spending in order to keep this computer equipment. That's the amount of money we're spending uh, in 3 months to keep the computer equipment, right? So that's why we're using depreciation expense. And accumulated depreciation just means the total of depreciation that we have used for that specific asset. Okay, let's do another one together. So it says that office equipment acquired again on October 1st and expected to have a 5 year life this time. Again, no salvage value at all. So again, we're going to come here for office equipment. So what was the initial cost for office equipment? We go to our unadjusted trial balance. Office equipment, you see $8,160. That's going to be our old cost, right? So that's 8,000. They said 5 years, right, of useful life, but we want them in months. So that's going to be 60 months. So we know again the formula is cost minus salvage value divided by useful life. So that's $136 per month. But remember, we're looking at it from October to December. October to December is 3 months. So therefore, it's going to be 408. Okay. And the same accounts apply here. It's a depreciation expense. So we're going to depreciate depreciation expense office equipment, and we're going to credit accumulated depreciation office equipment, right? And we did that. And as you see, again, we're updating and that is producing new numbers for us. You see how we started off the old balance as 0. Now our new balance is 408 because we made an adjustment, right? That same is true here. We started off with 0, new balance 1,375. The adjustment was at 1,375. Okay. All right, next one. It says 3 of the 4 months worth of prepaid rent have expired. So what's happening here? So think about it. So we got to ask ourselves, so let's go back here. What is the old balance? So we go to prepaid, they want prepaid rent. So that's going to be 3,500. Well, they said, what would the new balance be? We don't know right now because they didn't give us a new balance. But what we know is that 3 out of 4 months has expired. So of this prepaid rent, so there's 3,500, there's 4 months, right? 4 months make up 3,500 as prepaid. Again, check out previous videos or a previous video entitled Accounts, T Accounts Made Easy, where I talk about this stuff. But this prepaid rent account is paying for something upfront that you have not yet utilized. So what this is saying is we utilize 3 out of 4, so we have to make a shift. So we're going to take 3 out of 4 of the total. So that means that we use 2,625. So we're going to come here and we're going to debit rent expense. Why are we debiting rent expense, Dr. Akin? We're debiting rent expense because we're acknowledging the fact that is no longer a prepaid, but we actually utilize the rent for those 3 months. So we're going to debit rent expense for what we are adjusting, which is 2,625. And then we're going to credit, very important, prepaid rent. We want to reduce it. We want to update that balance, right? So if you look here, we said we started with 3,500. This was back in October, but we're in December and we used $2,625. So that means then our new balance as of December is 875. All right. So if you have any questions, or let's do one more together and then we'll be done. So 1231, right? So it says 3 months have expired related to insurance, right? That was paid in advance. Okay. So we know, again, we want to look for insurance. So it says prepaid insurance right here, right? So again, it says how much? 3. So 3 out of the 12 months now So this prepaid insurance is for 12 months. It's not for four, but this 1860 is for 12 months. We're saying 3 months of that needs to be taken out of that. So we're going to multiply 3 over 12 to get that percentage by 1860. So that means $465 needs to be taken out of prepaid insurance and put into insurance expense because it's no longer prepaid, it's an actual expense now. Okay. So we're going to debit insurance expense. We're going to credit prepaid insurance, and we're going to make it known here. So our prepaid insurance is going to be credited, as you see here, for 460, and you see that's going to update. So I'm going to put a zero here. So that updates the balance from it started with prepaid insurance at 1860 minus we want to reduce it by what expired 465. So now this is our new balance. But then we also have to do the other side as well, excuse me, where our prepaid insurance, or excuse me, our insurance expense is going to go up by 465, right? And that's important, thus making these balanced, right? All right, guys. So that's everything that I have for you today as it relates to adjusting trial balance. This is part two of the accounting cycle. Part three, I'm going to talk about then how do I take this updated trial balance, which is here, E, this is our new updated adjusted trial balance, and then produce a four financial. So I'm going to take this and now produce our four financials. So we're going to talk about that in the next video. All right, guys, please make sure you like, comment, and subscribe and share with those who also may benefit from it. I'll see you next time.